Hello and welcome back to the CRS podcast. I'm your host, Rumi, and today we're exploring two powerful strategies in the credit data world: lead generation and portfolio management. These topics are vital for businesses aiming to grow effectively and manage risk across their client base. I'm excited to introduce our guest, Jason Domazet, our Chief Revenue Officer. With over 25 years of experience, Jason has worked with major institutions like Bank of America, Wells Fargo, and Meridian Link. He has a deep understanding of credit data and the impact of smart lead generation and portfolio management on business success. Welcome, Jason.
Thanks for having me. I'm excited to talk about today's topic.
So let's get started. Jason, can you tell us why batch monitoring is important for businesses, especially those with loan portfolios?
So batch monitoring at its very granular level allows you to understand the health of your portfolio and what your customers are doing that you've already either funded or have purchased that account, so you can better service them. And that could be looking for customers that are in your portfolio that may be at risk of going into default, that may be looking at customers in your portfolio that might be in the market for other products and services that you're able to offer them. It might be as simple as looking at your customer portfolio to determine, what opportunities do I have to enrich that relationship I have with the customer and make sure that I am a viable resource for what their financial needs are. It also is a significant indicator of whether or not the risk analysis that you've done prior to funding those loans or making those credit decisions is accurate. So if you've based your risk decisioning methods on certain principles, that you have an expectation the portfolio will perform in a certain manner, and that portfolio performs differently based on the monitoring of that portfolio after time, then you have the ability of going back and restructuring your risk analytics and having a better understanding of how certain characteristics of that consumer's credit file may affect their overall performance in your portfolio.
That was well said and well explained. Thank you, Jason. So what are some common signs of financial risk in a portfolio, and how does batch monitoring help detect them early?
Batch monitoring can be trigger leads or monthly retrieval of information on the consumer credit file, and certain indications or patterns can be identified. As an example, at-risk candidates may be somebody who might be going into delinquency, not on your account, but maybe on other accounts that they have. At-risk candidates can also be candidates that might be acquiring a significant amount of debt in a very short time period. For example, if you made a loan to somebody that was already, at the limit of your risk threshold, based on their ability to repay, and you see that they've started securing other loans or other monies with repayment needed, that might change the way that you view that customer's ability to repay if there hasn't been a significant change in income level or asset level. The offsetting of this, the risk or the ability to reach out to customers before they default may also result in you having a better ability to recuperate funds that you've lent already. So as an example, if the customer looks like they're acquiring a significant amount of other debt or have started going delinquent, you may want to reach out to them and propose an alternative payment plan, maybe to lower their payments so they continue making payments to you on time, especially when those are asset-based loans like automobiles or homes. So there's a variety of reasons why monitoring portfolio health is very advantageous as a lender, to make sure that you're not at risk of a significant default rate.
So if I understand correctly, it's something like alerting, so the portfolio actually stays healthy.
Absolutely.
Awesome.
Beyond the initial underwriting that you may have done when you initially lent to that customer, people's lives change, things happen. They may have significant impact of or significant events that impact their ability to repay. So the portfolio management allows you to help identify those when you may not have consistent consumer contact at the face-to-face level, 6 months, 12 months post funding a loan for them.
I'm curious, how long is this product on the market?
It's this product has been around for quite some time, and a lot of companies will use this either in the interim to value and show that their portfolio is healthy if they plan on selling that portfolio down the road to another investor,
Right.
as well as by investors who've bought portfolios so they can monitor the ongoing health of the portfolio that they've purchased. So it may be at the servicing level. So not always are you making payments to who lent you the money, because sometimes they use outside servicing companies that will service those loans. So the servicing company may be using the portfolio product. The actual lender may be using the portfolio product if they're servicing their own loans. It may be somebody who didn't fund the loan but purchased a group of loans from the original funder that may be using this portfolio product. It's been around for quite some time, which means that the data strategy or the data analysis behind understanding what's happening in your portfolio continues to get better through
Mhm.
time.
Would you recommend this product for all companies or maybe only startups or even large companies?
Going back to what I originally said, I would recommend this product for both startups and large companies. Large companies certainly to monitor the health of your existing portfolio so you can identify at-risk customers. Smaller companies who may be newer on the scene that want to validate that their underwriting criteria are accurate based on the analytics that they've used to create that underwriting criteria. So if I am a startup or a newer lender in the market, and I've used analytics to create a certain amount of or certain number of underwriting criteria that I consider make a perfect candidate for my portfolio, and then I discover shortly thereafter that maybe those characteristics or those performance analytics may have been skewed in a direction that doesn't actually validate the way that the portfolio is performing. Having a portfolio monitoring product in place allows me to be agile and change my underwriting guidelines to mold to what actual risk may be that I didn't understand at the beginning when I started my lending process.
Question to the data source. Do we currently get a data from all the three bureaus or do we use other vendors as well?
So currently, right now, our product offering is from the three bureaus, TransUnion, Equifax, and Experian. The ability to maneuver between the bureaus is really important for companies that may not always use the same credit bureau when they're making underwriting decisions. So some companies will test different analytics and make or allow different cohorts to be underwritten by different analytics, meaning I may underwrite a certain cohort with TransUnion. I may underwrite a certain cohort using Equifax credit reports. And then I want to continue monitoring portfolio performance of those cohorts based on whether or not I felt that that initial credit report was sufficient for my analytics. That being said, having access to all three bureaus doesn't necessarily mean you're going to pull portfolio monitoring on all three bureaus, but you may want to pull portfolio monitoring on a singular bureau and then identify at-risk customers or customers that may be in the market for your other products and services, and then pull a secondary bureau to identify other changes that may have occurred in order to further validate their interest or their risk characteristics.
Can we dip a little bit into the history? I'm curious, why do we have a three bureaus in the United States?
Three bureaus. In the past, the bureaus were very geographical in nature. So TransUnion was always based in the Midwest, outside of the Chicagoland area. Equifax was based out in the southeastern US and Texas, and Experian was always based in the California or West Coast areas. So before reporting data on consumer credit actions was automated, it was often a manual process. And as a provider of this data back to the bureaus, you may not want to do it more than one time. So what you would do is you would go to the bureau that was located in your geographical location with the understanding that if I use that credit data in order to underwrite a customer for my product or service, that it was going to be very succinct and specific to other interactions that that customer had had in that geographic location. And then I may only report back to that singular bureau because I don't understand or know if my customer that lives in Chicago is ever actually going to interact with a bank in Georgia, as an example, where there would be a credit history with another bureau like Equifax. With the introduction of technology and the ability to quickly, concisely, and efficiently report this data to all three bureaus, the three bureaus literally have very similar data characteristics. So the need for multi-bureau reports is been reduced to very specific industries that are maybe higher risk or have underwriting guidelines that require all three bureaus in order to make sure they're not missing any characteristics. So the origins of the bureaus being three separate locations is much less pertinent now because all bureaus operate both nationally and some bureaus operate internationally with credit data in other nations as well.
I actually really find the history of the three bureaus very interesting. So thank you for mentioning it.
You're welcome.
We covered the topic of batch monitoring, and I would like to kick off first question regarding marketing lists. So when we talk about marketing lists, what exactly does that mean, and why should businesses care about targeting specific audience?
So marketing lists or lead generation can be the lifeblood of an organization. It is ideally a set of potential leads that you could service with your products and services, or offer your products and services to, that those candidates are ideal based on your ICP or your ideal customer profile. So as an example, if I'm marketing automotive refinance loans, to customers that recently purchased vehicles that may have used dealer-specific financing, and I want to come in and try to refinance them at a lower interest rate. A lot of banks and credit unions may do that, or a lot of sole auto lenders that don't have indirect relationships with car dealerships. Then I'm going to want to look at a certain set of leads, presumably in a lead list that I'm going to purchase, that I want to market my product to, that have certain credit criteria, that have had a new auto loan opened within a specific time frame. Maybe that auto loan should be a minimum dollar amount. Maybe my target might be $10,000 or $20,000 or greater. Maybe I'm looking at a particular consumer that has a monthly income of at least $10,000, $12,000 per month, whatever it may be. But I can come to an institution like CRS that is able to look at bureau level data and retrieve a list of these ideal customers that I should be marketing my products and services to, that are likely in the market for what I have to offer. So that can become the lifeblood of my marketing initiatives, whether it's call centers, whether it's social media marketing, whether it's direct mail pieces, whether it's email campaigns. All of those different avenues to reach customers are really not valid unless I know the customer that I'm trying to reach has a need or is in the market for what I'm offering. So we provide a way to satisfy that need.
Let's talk about use case. In case that I would be a car seller, what question I would come with to CRS?
Well, first of all, it's really keen to understand, or it's really important to have a keen understanding of who your ideal customer is. What is an ideal lead for you to market your services to? And that can be all sorts of demographics. It could be geographical location, it could be age, it could be income, it could be whether or not they're homeowners, it could be whether or not they've had no delinquencies in a specific period of time. It could be the amount of outstanding debt they have, the kind of debt they have, maybe how much debt they have in comparison to what their overall available credit lines are. So all of those characteristics, inclusionary and exclusionary, can be packaged together and we can pull out a list of candidates that would meet those certain criteria. So it's always important to understand who your customer is. And for some institutions, it may take some A/B testing. They may be thinking that their ideal customer profile is a certain individual with certain characteristics, but maybe tweaking those characteristics for their second list may result in better success rates. We also have the ability with some of our products of providing an actual head count based on how tight or how loose those criteria are. So if you come to me and say, I have these particular set of criteria that I need to meet, and we come back to you and say, okay, there is 150,000 individuals that meet those criteria, and you, as our client, say, well, that's a lot. Maybe we can tighten this up to be even more inclusive of customers that have a specific need set, then we can go through and we can pull those levers or move those levers to tighten that up and get you down to the head count that you're looking for. So you can understand. Likewise, on the reverse of that is if you come to me and your criteria are so tight that you're getting very small lists, we may want to look at tweaking those criteria in order for you to get a more substantial number of names. It might require, loosening some credit criteria, loosening some income criteria, but there are certain ways that we can certainly look at that and get you a head count. So the importance of understanding who your customer is really paramount, and the willingness to do some A/B testing to make sure that those leads that we're generating for you are actually going to be successful customers of yours as our client.
So, if I understand, you would recommend potential customers to come up with maybe some characteristics and then test it with us.
Sure. Yeah. I mean, like I said, there's some A/B testing that can be done. I would advise that they at least look at some of the characteristics, and a lot of those characteristics are determined by their risk analysis of who they want to lend to, as well as if they are lead aggregators themselves that are pre-qualifying customers before they send them to a lender. Oftentimes, there are very straightforward lender criteria that would fit into or help them identify who their ICP is. So if you're working with a set of lenders that only want consumers that have or applicants that have credit scores between 650 and 750 or 650 and greater, then it's as simple as there's your first criteria that we have to meet, and then we can build off that based on those lender qualifications, or the way that those lenders would like you to segment them into buckets.
What are the most common industries that can use this product?
Well, consumer lenders, automotive lenders, mortgage lenders, pretty much anybody that's doing any sort of lending practice that wants to target a specific set of customers that have a specific need identified based on their credit profiles. Home equity lenders, any lending function can use this product and find success with reaching candidates that would need their product and are in the market for their product.
How fast the customers can figure out their true demographics?
I mean, it's really highly dependent upon the frequency that our customers are ordering these batches of leads. But if you're going to A/B test and you're going to A/B test a significant number of leads in a short time period, the other component of this that's really important is what does the funnel look like on our client's side? How quick can those customers move through the funnel? If you're talking about the mortgage industry as an example, that funnel typically moves, 30 to 45 days from start of application until that closed or till that loan closes. But if you're talking about an auto loan or a consumer loan where you may have an onboard, a web onboarding with an automated decisioning engine, you may see success from those or success from those applicants that you've reached out to within, days. So it's highly dependent upon the industry, but we've seen some customers have very successful runs of leads and onboard new customers, within 7 to 10 days. It could take months, just depending on how long it takes for them to analyze the quality of the consumers that they were able to reach and how quick they were able to move through their funnel just based on, how their funnel operates or how their process operates.
Right. And for businesses just getting started with targeted marketing, what advice would you give to maximize their outreach efforts?
Well, I would certainly once again reinforce that having an understanding of who your ICP is and maybe who you want your ICP to be in the future is very pertinent. I would also understand and have a great understanding of how you're going to utilize your resources and how quickly you can reach out to these customers. One thing that really sets our data apart from other vendors is our data is live. It's not archived, it's not warehoused, where other companies that provide leads may be only refreshing those every 30 days, 60 days, or 90 days. Our data is refreshed daily based on consumer credit profiles changing at the bureau level because our data is coming from the bureaus directly. That being said, you need to make sure that you have the resources available to do an immediate reach to those clients because you got to strike while the iron is hot. So you want to make sure that you are reaching these customers when they are in the moment and they're ready to make a decision. So it's important to understand your resources and how quickly you're going to be able to reach out to those potential leads. And thirdly, you have to understand, I think, from a budgetary requirement, what am I willing to spend, and what's my realistic understanding of what my pull-through or success rate is going to be. So that should directly affect the amount of money that you're spending because on the surface, the product can seem not inexpensive, but not expensive. But understanding how many customers you need to onboard from pulling a batch like this at a particular dollar amount helps you understand whether or not you're pulling enough names to really make it worth your while. Larger batches, as long as you have the resource to handle those larger batches, are going to result in more, a significant lift in the number of customers you're going to touch and potentially success rates, as long as your ICP is correct, or as long as your ICP is targeted towards who is a good candidate for your products. So understanding your budget restraints and constraints, understanding your resource constraints, and understanding your ideal customer profile, I think are the three components that would lead to having a successful lead generation campaign using this product.
Well, I think we can end this podcast episode with one last question, and which was pretty interesting, I'd say. So, are there any common misconceptions about credit data that you'd like to clear up for our listeners?
That's a very, very broad topic. Wow. Uh, I would say that I think the common misconception is there's no easy way to fix your credit as a consumer. And you know, the recipe for understanding your credit score and understanding your credit consumer profile is so available now through resources offered by the bureaus. And as a client that's using credit data, I would make sure that you use those resources for customers that, that don't understand their credit profile or maybe may not meet your criteria. But I think there's a lot of misconception around, fix it quick uh, uh, conceptions and or conception of being able to do that, and it perpetuates a problem in the industry. One of the other great misconceptions about using credit data is, who can use it, how it can be used. From a technology perspective, I always say I can provide anybody a connection to pull credit data, but there are a lot of bureau restrictions and compliance requirements around the way the data is used and who has access to that data. Because there's a lot of bad actors, there's a lot of fraudsters that if this data fell into the wrong hands could be very detrimental to your consumers. So understanding who can see the data, how the data can be used, and what uh, the end purpose of that data is, or how it can be used in order to make a decision, not make a decision, invite an applicant. There's a lot of misconceptions that float around out in this market space. I think the other single biggest misconception is the difference between a soft inquiry and a hard inquiry. A lot of times it's the same data content, or it is the same data content. The report body is going to look the same. The biggest difference is really the use case and the compliance restrictions and requirements around the use of pre-qualification or soft data reports versus hard inquiry reports. So those are all things that we can help the customer navigate and identify and put them in the right product. One of our goals when we onboard anybody is always longevity of a relationship. And part of that recipe for longevity is compliant use of the data. So the bureaus don't come in and say, you can't service that company any longer. So that's an important part of what we do here.
Great. I want to give you a huge thank you, Jason, for sharing your expertise and valuable insights on lead generation and portfolio management. It's been a pleasure having you on the show. Thank you again.
And it's a very diverse industry with a lot of compliance and nuances to it. So I'm always happy to spread the wealth of knowledge for what I've gained over my 25 years being in this industry.